The United States prized top AAA credit rating has been cut for the first time ever. Standard & Poor's has dropped America's ranking to a AA+. Now, the destructive force is the crippling debt, which Congress has struggled to agree on how to tackle, with only an 11th hour deal to raise the amount allowed. Well, S&P says that's not enough and falls far short of what's needed to stabilize the government's runaway borrowing. But the Obama administration says the analysis is way off and will damage any recovery. Well, RT's Lucy Kafanov is in Washington for us.
Good afternoon, everybody.
It really is, more than anything, a huge symbolic and unprecedented blow to the United States, to its status as a safe investment. Basically, what this credit rating lowering does is it really raises questions about the validity of the United States and the ability of the U.S. politically to get its financial house in order, so to speak. The repercussions here for the American people, for the U.S. government, could be severe. Now, while this only takes it down from a AAA to a AA+ with a negative outlook, threatening, in fact, that the rating could get lowered even more in the next 2 years. What it does is it potentially sends the message that the United States is a risky investment. That could send interest rates going up for the federal government, and because other borrowing costs are tied to that, that means mortgage payments could go up, mortgage interest rates can go up, car interest rates can go up, and really the rest of the U.S. economy could be severely affected. Now, one thing that we do have to keep in mind here is that the Obama administration had pointed out that the S&P had made an error of about $2 trillion in projections in releasing that information. Now, the S&P doesn't make these decisions based on any sort of special information. It really is a political reaction based on facts that are available to just anyone. And so the other thing we have to keep in mind here is that these same credit ratings agencies essentially allowed top ratings to continue in the United States at a time when we were investing a lot of money in these mortgage securities that essentially ended up collapsing and pulling down the U.S. economy with it. So they don't really have all of that much credibility in the eyes of the world market. Still, however, we don't know what will happen come Monday when the markets will open, and if those interest rates do rise, there could be a ripple at this very unstable economic time here in the United States. With the passage of this debt deal, the U.S. government's hands are essentially tied in terms of stimulating the economy, in terms of any sort of new spending that could boost growth. We saw GDP growth had stalled to almost a crawl in the second half of the year. We saw, on top of that, the jobs report that came out on Friday for the United States. While it was somewhat positive, it actually showed negative growth because it means that more people here in America have given up looking for work. So politically, there's really not that will in Washington to do what's needed to stimulate growth. And financially, they simply do not have the tools in their possession in order to improve things here. And so while these credit ratings agencies may sometimes be accused by some financial experts of having missed the mark long ago, these small, tiny effects in terms of higher interest rates could really, really cripple what's already seems to be a worsening recession here in the United States.